Right, hi, welcome to the StockRanks webinar. This is titled Building a StockRank Portfolio, and it's going to be a 1-hour webinar, and we're going to be covering a lot of ground. This is very exciting for me. I could spend a whole day on this. There's so much material I've gathered that it's very hard to actually fit it into an hour. So if you're interested, please do let me know, because I'm thinking about doing a 1-day course. This original webinar, the recording corrupted, so I am re-recording it and hopefully sending it out to everybody who'd registered. My name is Ed Croft. I am the co-founder of Stockopedia. I am a former stockbroker and fund manager. I'm an Oxford-educated geek, and essentially I'm a highly motivated private investor. I left the city, wanted to invest personally, found that there were some really terrible tools around, and one thing led to another, and my own research project turned into Stockopedia. And everything that we're building on the site is designed to solve investment problems, and hopefully I'll be showing you some of the ways that I use it and have used it to try and build market-beating portfolios. Before we start, I must put this disclaimer in place, which essentially tells that we are not giving financial advice. This is very much an educational webinar. I want to explain what I've done and how I've got to the performance this year. Our tools on the site are for information purposes. We always say DYOR, please do your own research. It's very much a DIY investment tool. A lot of the stocks that you might see in this webinar are highly ranking. There's obviously no promises that the future will be as good as the past. What are we going to get onto? What are we going to talk about, and what's the agenda? Firstly, I'm going to run through what's called the NAPS portfolio performance review. I'll explain in detail what this is, what the NAPS are, what the standout winners and losers have been, what's gone right, and what might be improved in the future. I want to show a live demonstration of how to construct a StockRanks portfolio. I will be demonstrating it using the StockRanks Portal and the folio tools and possibly the screener. And I will be talking about diversification approaches and lessons I've learned this year. We will also talk about ongoing portfolio management, sell rules, rebalancing, etc. And we'll also do some closing thoughts. As this is not live, I will be trying to answer some of your questions at the end that people have actually said to me. And hopefully this will all be done in about an hour. If anybody is not a subscriber to Stockopedia watching this webinar, I will hopefully be giving you some reasons to sign up throughout the webinar to show you, and sharing some links at the end. So please do stick around. Great, let's go straight on and look at the portfolio review of the NAPS. Okay, firstly, this has been 2015. It's beginning of December. We've had 11 months. This is the performance of the FTSE All Share. Now, I'm focused on the UK market because probably 80% of our subscribers are British and predominantly invest in the UK market. But these tools can be used internationally in the US and European markets too. So we're also launching Australian and Asian exposure on the site pretty soon. But this webinar is going to be predominantly about the UK. So this is the performance of the FTSE All Share, which is the benchmark that a lot of UK investors use. As we can see, it's been a pretty average year. Nothing exciting has happened, etc. And this is the performance of the New Year NAPS portfolio. It's a 20 stock portfolio and it's returned almost 40%. It's taken me massively by surprise, and to be honest, if I'd known this was going to happen, I would have sold my house and everything else with it and put it all in the stock market and geared up enormously. I didn't. But I did invest my own portfolio according to very similar rules. I actually diversify more broadly and I use a bit of short selling, and my performance actually outperformed the NAPS. But I know this has worked very, very, very well this year from a personal perspective. Now, what are the NAPS portfolio? How was it constructed? And why is it called NAPS? Well, essentially, it comes from the card game Napoleon, where a nap hand is a declaration that you can take all 5 tricks. So it's only ever used when you've got very, very strong odds. It's a phrase that actually started being used in racing tips, the NAPS, and it also started being used in tip sheets. So that's where I first came across it, and we used it at the beginning of the year actually as a bit of a riff on this idea, but saying we weren't going to create our own tips for the year, but what we thought is we could apply a mechanical, rules-based process using Stockopedia statistical tools to come up with a set of stocks with a high probability of at least doing as well as the market, and hopefully, if we were lucky, doing better. There's more reading at these links. The PDF will be attached to this email, and we'll try and put it on the video as well. And you can read further at all these links at any time. So, the way that we did this, we created the portfolio according to these rules. Firstly, we ranked by descending stock rank. The stock rank is Stockopedia's proprietary core ranking method. There are other ranking methods, but this is our proprietary one. And that's the main one on the site. I'll explain it in a little bit more detail shortly. And then we excluded small and hard to trade shares. So market capitalization of greater than 20 million to keep all the real little tiddlers out. And also ensuring the bid-ask spread, the spread between the buy price, what you can buy at and what you can sell at, is less than 5%. Because we want to make sure there's nothing super hard to trade in there. And then what we did was we picked 2 stocks from every sector. So the highest ranking 2 stocks that met these criteria. That was it. And the performance has been remarkable. And I'm going to be investigating where this performance has come from over the course of this webinar. Now, looking at some of the biggest winners of this 20 stock portfolio, you can see here are the top 6. International Greetings, small card distributor, and that returned 130%. Dart Group, which has been possibly one of the biggest winners for Stockopedia subscribers since we launched. I think it must have, I don't know how many times it's multi-bagged now, but it's still going up. And I don't think anybody expected it to go up 85% this year. There are other good stocks in here like Character Group, which does distribution of Peppa Pig toys and so on. But the one thing about all these shares is that they are not exactly the glamour stocks in the stock market. And, these are not the kind of shares that brokers get excited about. And this is something I can say again and again and again about what pays off in the stock market, is that it's often not the shares that are most exciting. Looking at the total spread across winners and losers in the NAPS portfolio, we can see that there was only one loser in the entire year. And that was Lamprell of the oil and gas sector. And the second worst performer was Catlin, but that's because it delisted after about a third of the year. And almost every other share has performed remarkably well. So only one share has underperformed the FTSE. All the rest have been winners. And you could even take the top 10 stocks out of that, and you would have still had a 15% return over the year. So it's been a remarkably consistent and quite... I've been so surprised by the performance myself. Now, just so you know, I'm not pulling any wool over anyone's eyes. There are a couple of our subscribers who have been blogging about how they've been getting on using the stock ranks and the screens on Stockopedia for the last 1 or 2 years. Mechanical Bull is an independent blog. He's returned something like 67% in 2 years, which is a fantastic return. Grinder Trader, in the 1 year that he's run a StockRanks portfolio in parallel with his own personal discretionary portfolio, he's returned 38% in that 1 year. So there's definitely, all we can say is there's definitely something to the system. So let's have a little look at how we built this portfolio. And I will then come back and talk a little bit more about the stock ranks. Essentially, we built it using the StockRanks portfolio. Now, I've got a slide actually, which actually talks a little bit about the philosophy that we used to build the portfolio. I call this my 4 principles for stock market success. That sounds a bit naff, but it's my own personal evolving philosophy that I'm using myself. The first rule being managing the monkey. We all make mistakes in the stock market, and we're very, very prone to behavioral biases. It's a legacy of our, chimpanzee background, our survival spirit, whatever it is. We are, our own worst enemy. And I've found, and so have many, many researchers, that the one thing that we can do is put rules and checklists in place that mean that we adhere to sort of more systematic processes that get a better outcome. So number one rule is actually using rules. Secondly, aligning with the payoffs. There are certain key drivers in the stock market that the academics have studied for the last 50, 100 years, which consistently pay off. And that's value investing, cheap stocks beating expensive stocks, momentum investing, and quality investing that we actually have pulled together into our single stock rank ranking factor. And it's very important to invest at the extremes. Invest, which is sometimes investing where others aren't comfortable to invest, not necessarily in the glamour shares. And we can use statistical approaches to find the stocks most exposed to these payoffs. Thirdly, giving every stock a role. That means making sure that one is spread across sectors, that we have defensive shares, that we have cyclical shares, we have sensitive shares, that we don't throw everything into the oil and gas sector just because everyone else seems to be. It's about actually making sure that our portfolio is robust. I sometimes like to think of it as a football team. And fourthly, keeping the balance. Rebalancing, position sizing. This is all about keeping the balance in a portfolio and making sure that we're managing the risk on an ongoing basis, because over time stocks drift. They drift away from the exposures to those payoffs, and if we want to keep aligning with the payoffs, we have to keep rebalancing back into the more promising stocks. Now I wanted to show you a little bit on the website about how I built the NAPS portfolio. So look, I'm going to first of all show you the NAPS portfolio, which is here. This is the portfolio that I've been tracking all year with an original nominal £100,000 and it's, as we can see, here are all the percentage returns. And this has been, as we can see on this list, there are quite a lot of the stocks still have very high stock ranks. So the stock rank, for example, of Dart is now again the highest ranking stock in the market. At some point that's got to fall out of bed. I don't know when it will. But a lot of them are still ranking very, very highly. Some of them, though, as we can see, BT here has dropped off significantly. It's now a 63 stock rank. It's the kind of share I would be personally rebalancing out of because it's not exposed or aligned with the payoffs anymore. But a lot of them are still very high ranking, and that's a way that when we are rebalancing that we can consider minimizing the transaction costs. But we can also have a look at the market caps. We can see there's a few large caps here, quite a lot of mid caps, but then there are a lot of much smaller caps and worse. So and I think one of the things that I personally am uncomfortable with in 2016 is having too many micro caps in the portfolio. It is a double-edged sword, obviously. If we look at the stock report for International Greetings has been a fantastic performer. It's come off, let's say, a 30 million market cap and has done 130%. But these kinds of small stocks are a double-edged sword. You can do very poorly in them, as we shall see. But anyway, that's the portfolio, and I'd like to show the allocation because this shows that the portfolio is still well diversified across sectors. But if we scroll down and on the right, these horizontal bars show us the size of the position relative to the others in the portfolio. And this shows you that International Greetings have now become 8.5% of the portfolio. If there was a profit warning and it dropped 50%, we might hurt. And as we've seen, there have been a lot of profit warnings across the whole market. It's been quite a bad quarter for profit warnings, and let's not pretend that our portfolio, the NAPS portfolio, is immune to it. So that's something that, bringing these position sizes down would, by rebalancing, would minimize the risk of if the stock's still qualified. Now, let me go back to my... now, I wanted to actually show you how I built the NAPS portfolio because it's very straightforward. I need to do just a moment of prep and just make sure that I have my portfolio free. Okay. Now, if I go back to the Ranks portal, this page shows us all of the top ranking stocks on Stockopedia in descending stock rank order. Important to understand. These other pages, the movers page, And the performance page, they show us more information about the stock ranks. The performance portal is particularly useful for people that want to investigate how the stock ranks have done. Let me flick back to the slides because I have some information here for you. Learning more about the stock ranks. I have done full 1-hour webinars on the stock ranks, and I'm not going to repeat myself now. I will just breeze through for people who don't know about the stock ranks. But if you're interested, please do look up at those links. You'll find a much deeper investigation into the stock ranks. Essentially, we publish the stock ranks on the top of every stock report, and they are the, let's say, we use what is called a multi-factor approach to create rankings for value, quality, and momentum. So we use about 6 fundamental valuation ratios to come up with the value rank. We use more ratios for profitability and health and margins and cash flow to come up with a quality rank. And we have a momentum rank, which blends price momentum and earnings momentum. In a nutshell, this shows us and tells us if stocks are good, cheap, and improving. Now, this is all based on a lot of academic research. We're trying to find shares that are exposed to value, quality, momentum, and the overall stock rank sits right in the middle as a blend of all 3. Essentially, we're trying to find what I call good, cheap, improving shares, and our portfolio, if it's well constructed, should contain a whole set of good, cheap, improving shares across all the sectors. Robert Haugen called these kind of shares super stocks. The opposite is the profile you really wouldn't want in your portfolio: expensive, deteriorating junk. And these are the kinds of shares that most private investors seem to prefer. I don't know why, don't ask me why, but I keep investigating and I keep finding evidence of it. Hopefully at Stockopedia, most of our subscribers don't. But anyway, the stock ranks performance, as I said, has been really remarkable. This is a chart that shows the top, all the different deciles of the rankings. The top line here is the stocks that have been ranked 90 plus and how they performed. And the bottom line shows the ones that have ranked very, very poorly and they have massively underperformed. But I think what's even more interesting is this slide, which shows you the hit rate of picking winners at different levels of stock rank. So if I just go back to the back here and show you dark group, this stock rank up in the top right hand corner, here we see it's 99. The column here on the right shows us the hit rate of picking of winners of stocks that are ranked 90 plus. The next one shows ranks 80 to 90, and the one far on the left is 0 to 10. I'm trying to think of a 0 to 10 off the top of my head. I'm not sure I can, but let me just have a look at something like Rockhopper, kind of classic company, which is a very low stock rank of 15. Anyway, the probability of picking winners has been highest in the higher ranking stocks. There's been a 70% chance of picking winners in the average year since we started tracking this, which has been far higher than all the rest. And you can see there's this huge correlation with the stock rank for picking successful shares in the UK market. And so the NAPS portfolio has done actually remarkably well because we only picked one loser. So surprisingly, it's done even better than the average, which has really taken me by surprise. Why is... now, I'll come back to this slide in a minute. I want to show you how we have built, we can build the NAPS portfolio. Now, I mentioned at the beginning that it was a portfolio that cut out all the micro caps. So the first thing on this page I do is go to the filter on the left, click size, and find more than 10 million minimum size. And once I've done that, I then click sectors, and I wanted to pick 2 shares from each sector. I'll explain a little bit further detail why I'm doing this. But as simple as that, I've now found all the shares with a higher than 10 million market cap, and these are the top 2 ranking, NWF and DCC. That one's a 99, but this one's an 86. So what happens is we're going to the sectors and we're finding the top 2 ranking shares and not fussing too much about what the stock rank is. And I'm going to add that to my NAPS webinar portfolio, which with any luck, you'll now see they're added, DCC, NWF. And I'm going to do the same for all the other sectors. Let's start again. Basic materials. We go up here and I can click, I can see, let's add Robinson and International Greetings. Add to folio. NAPS webinar portfolio. And again, the one thing to be aware of is what I like to do is I like to hold when I'm clicking this button, let me just do this for Dart and Alimask. When I click Add to Folio, I click either the Command button or the Control button on a PC. It opens it in a new tab, and it saves me from having to reset all my filters. So now I'm going to just quickly rattle through all the other ones. Character Group and Barclay Group, add to the NAPS webinar. Now I'm going to go down to Consumer Defensives. So we're going through each of 10 sectors. And I'm selecting the top 2 shares to each. I'm going to go again. H&T. Lighthouse Group. This one is ranking very highly, performing very well, but it's got a 12 million market cap. It's too small for my rules. So I'm not going to be putting that in that portfolio because I had a 20 million market cap cutoff. So the next one is healthcare. And again, animal care and Indivior. I'm going to keep going down. And Pure Wafer. Universe Group. I talked about bid-ask spread. I've already done my research on this. I already know that the spread is too wide. So I'm actually going to miss that one because I know the spreads are wide. I'm just going to save myself some hassle, but I'll explain it when we're looking at the portfolio view in a little bit more detail. Again, Zamano. This, I know nothing about this, but it's a 10 million market cap, and I don't want 10 million market cap stocks, so I'm doing the same thing. And now finally, utilities. I'm going to take the top 2 there. Now we have the overall NAPS portfolio that I've created as of today's date. Now we can see automatically we go through to the webinar, the portfolio page. And by the way, all the portfolios are always available up here from the folios drop down. And there we can see this is the NAPS webinar list. And all of those shares are now in this holding watch list. Now I've customized this view slightly so that I can see the bid-ask spread. And one of the things that people often don't look at is the bid-ask spread. Now, people who don't know what a bid-ask spread is, essentially the ask price is what you would buy a share at. The bid price is what you would sell a share at. And a market maker will always make sure there's a spread between those two because that's how he makes money. Now, if you were to... Some companies are illiquid. It means they don't trade very often. And to manage that risk of being stuck with stock, the market makers will sometimes make a much wider spread. Now, so that basically means if you were going to go and trade Adept Telecom on the same day, buy it and then sell it immediately afterwards, you would be 7.4% out of pocket. Now, that's a very tough thing to do because if you bought that share and then you went into your portfolio, you'd see a 7% loss on immediately if it was valued on the bid price. The spread is quoted in basis points, which is where 100 is 1%. So that's why these numbers are much larger than the percentage. But you can see we wouldn't be necessarily comfortable owning Adept Telecom if we were going to stick to that rule. So I might actually go, right, that's a telecom. I'm going to delete that. And I'm going to go back to my StockRanks portal. And I'm going to find another telecom that perhaps the next one down, which perhaps might not have such a wide spread. As an example, I don't know, Adept's still there, but that's exactly what we do. I'm not sure why, I must have clicked the wrong one. There we go. And now we've got our portfolio of 20 shares with any luck, and I'm not sure that actually worked. So let me do that one again. Go back to the StockRanks portal. It's no harm me showing you this again and going in. There's the 4th share, adding to portfolio. I'm adding it into my portfolio and I'm done. I've got 20 stocks in this portfolio. Now we can see the biggest spread is 4%. It's spread 2 by 2 in every sector with any luck. And that is basically what I did at the beginning of the year. And simple as that. Now, there are a few things I wanted to quickly discuss because a lot of people, firstly, when you look at this list, I am filled with horror. I don't even know what some of these companies do. I don't know, and I feel an emotional reaction which immediately says to me, just run a mile. And I felt it at New Year, and I'm trying to train myself away from it. One of the things I've always found is that people find buying high-ranking stocks very hard. And I think it comes down to the fact that it's contrary to human nature. Nobody likes buying cheap stocks, mainly because cheap stocks have got problems. They might be cyclical. They often have problems. Nobody likes buying good stocks because they tend to be boring. So most of these shares in that list will be profitable companies, and they often be really boring business sectors. They're in every sector, but frankly, they're all pretty boring shares. I don't find anything exciting about that list. Also, nobody likes buying momentum stocks or leading stocks because they tend to be scary. If we go and have a look at the price charts, and if you go back to the portfolio, and if you see up here in the top right corner, right here, you can click the chart symbol. And yes, there we go. Classic example. Almost all the stocks in this portfolio have got rising share prices over the last year. They are momentum shares. They have done well. They look scary to buy. Very few of them have like Individual there, are actually on looking like they're coming down. Now, anybody going and trying to buy shares, how many people are going to go and buy Computer Center or Dark Group or DCC or Gamma Communications when they've got charts like this? Not very many. So it's very difficult to buy these kinds of shares for those three reasons. And this is one of the reasons why I have faith that the StockRanks may well continue to outperform, even when they're widely adopted and people are using them. My experience is in the list of shares, people will tend to buy the wrong stocks in the list. That's my experience. We see it time and again. Okay, a few quick questions. And people will often ask me, Ed, why 20 stocks? You always go on about diversification. Why diversify so broadly? It's about having 10 stocks in a portfolio, or I want to own 8 stocks. I want to make sure I get rich. And I can answer this question very simply. Firstly, there is this phrase from Warren Buffett that I think is the most dangerous quote in finance, where he says diversification is a hedge for ignorance. Now, unfortunately, that plays to all of our overconfidence, because none of us like to admit we're ignorant. Well, the truth is, anybody investing part-time basically is quite ignorant of what's really going on in the companies. No matter if we're business analysts, accountants, trained consultants, really, the time that we have to really investigate shares to the depth of someone like Warren Buffett is minimal, and he's got a huge team behind him. I am very happy to know that I'm ignorant about most of the shares in a list that I buy, because I know that I have understanding of other things. I have an understanding of what pays off in stock markets, and I understand that value investing pays off. I understand that momentum investing pays off, and I don't mind a certain element of ignorance of certain stocks. And in fact, because I am ignorant, I'm going to make sure I diversify across, and I'm going to make sure I diversify broadly, but in the stocks most exposed to the factors that pay off. Now, I wanted to show what happens when someone picks 5-stock portfolios, because having a concentrated portfolio leads to very, very wide outcomes. And now this is every grey line in this chart is a 5-stock portfolio picked totally randomly from Stockopedia's highest stock ranking decile. So that means that throwing darts at stocks with a rank of 90 plus, and you pick 5 that you throw a dart at, this is the kind of range of outcomes you could have had. This is actually, I did this study last year, so this is up to last September, but it shows you the range of outcomes that there could be. You can underperform, you could do very well, who knows where you end up. This is random 15 stock portfolios, and as you can see, the range here of outcomes becomes tighter. And as we add more stocks, 25 stock portfolios, the range of outcomes becomes tighter and tighter and tighter, eventually ending up very similar to the decile return. So the thing is, people have got to ask themselves, do you really want to have a high risk of underperformance or ruin by investing in 5-stock portfolios? And these are random portfolios, remember. The portfolios where people have picked 5 stocks and selected them often do much worse. Why? Well, people have a tendency to buy shares that are very familiar, and they tend to buy shares which are most discussed, and they tend to buy shares that often have most excitement. These are all behavioral biases that tend to gear us away from the boring shares that actually often tend to pay off the most in the stock market. I love this quote from Joel Greenblatt, who made 50% a year in the stock market. He said, if you're doing a limited amount of work on individual stocks or no work at all, like most investors, diversifying with 20 or 30 magic formula stocks is most definitely the right plan for you. He wrote this in his book, The Little Book That Beats the Market, and his magic formula is similar to the Stockopedia StockRanks in the sense that it tries to find good, cheap shares. It's a systematic strategy, and he's a very wise man. And just to prove another point to you, occasionally I get people trolling me on the website, and people often, someone was saying, look, the original article was about the top 10 stocks. Well, it was about the top 10 stocks, but it also, I said in that article, we'd be tracking the performance of the top 20. There were 20 stocks listed in the original NAPS article, but 10 of them had a slightly more detail. Now, this is the performance of the top 10. The top 10 did 31%, which is still a pretty stunning return over the course of the year. I focused on the 20 portfolio stock. Personally, I believe in diversification. And my own portfolio has about 35 in it. And I do not believe that owning more shares leads to worse returns. It's a myth. And also, any fund manager who had a 20-stock portfolio would probably be seen as madly concentrated. So why private investors always believe they should have only 5 or 10 stocks, I do not know. But what happened in the 20-stock portfolio is that some shares like International Greetings crept in. International Greetings returned 130, 140%, and has driven a lot of that extra outperformance. If you have a slightly wider net, you might be more able to catch the truly stunning returns and truly big winners. How many stocks? The one thing is, diversification is a problem for people with small portfolios. I've created this spreadsheet online. Please do go and read this article. It really might help people think about their costs. I always say that the average fund manager has about a sort of 2.5% cost of investing, and I think if your process actually has a similar sort of level of cost or less, and you're investing yourself, then it's very sensible to be your own fund manager, as it were. Now, people with smaller portfolios, I think, to be honest, there's a huge amount of education that people can get investing in 5-stock, 10-stock portfolios. Obviously, if you are investing in 25-stock portfolio with about £5,000, it could end up costing you 12% a year, which is not an overcomable hurdle, but it's very, very, very difficult. So, one needs to sort of slightly weigh up how many stocks are in a portfolio depending on the size. There's a Google spreadsheet that people can go and look at there. Now, so I hope that answers why I believe in diversification of the breadth of a portfolio. But the next point is how many sectors. A lot of people say, look, why do I want to invest in all these other sectors? I don't want any utilities. I don't want any of this. I want to put all my stocks in the sectors which have got the best companies in it. Now, that's fair enough. And I think what some of these people do is they like to go and they set up a stock screen. And they will set up a stock screen to find high-ranking shares with maybe one or two other, factors, and they will put it in the top 25 in their portfolio. Now, there is a problem here. If you look down on the right-hand column, you will see that there is 1 industrial, 2 industrials, 3, 4 industrials, 5, 6 industrials in the top 20 shares here. There are 1, 2, 3, 4, 5. There are 6 cyclicals. You've got 12 industrials and cyclicals. These are sensitive cyclical companies which, you'd be putting the majority of a portfolio in when who knows what's around the corner next year. I want to make sure in my own portfolio that I have a robust portfolio that can weather bad market environments. Now, that is why I like having defensive shares in my portfolio. We use a sector classification schema from Thomson Reuters, and it has 10 economic sectors, and it has 28 business sectors, 54 industry groups. At the moment, we're only publishing the 10 sectors and the 54 industry groups, but we might publish the others in future. But what these 10 sectors, they allow us to invest more broadly across a lot of economic areas. Remember, utilities used to be the growth area of the market back in the 60s. They're now very much a defensive part of the market. So you get some defensive sectors, and you also get the more cyclical sectors. So investing across more sectors actually could make a more all-weather portfolio. And I wanted to show what happens if somebody had invested in the top 20 stocks by StockRank at the beginning of the year. This is what the return they would have got. That's the top 20 shares by StockRank, again above a 20 million market cap, but it would have been a 22% performance. So just investing in a tight portfolio which is quite concentrated in certain sectors might not have done as well. Sometimes diversification can actually pay off better. So, and I very much believe in it. Now, often also, one of the other things that people can do is people often get stuck in small and micro caps. Most of the chat in the stock market is about micro cap shares, and that is a double-edged sword. Yes, we've invested in International Greetings. So if we can find it, it's done exceptionally well and 130% over the year. But this was I think it was a 30 million market cap company? I'm not sure. And it's done exceptionally well, but these kinds of companies are a double-edged sword. When they fall and they have profit warnings, they hurt really badly. So, we've seen some recently, some higher ranking stocks that have had profit warnings, and we actually had one recently which dropped 75%. So, being concentrated in microcaps can be a bit of an issue. So one of the things I like to do, either I can go and actually click into these sectors and try and focus just on large caps and try and select just a few large caps in different sectors. Then I could select mid caps, just some mid caps, and actually spread more carefully across different size groups. And also, sometimes small caps massively outperform, but sometimes late in bull markets, as Ken Fisher has said, large caps can massively outperform. So being exposed to different areas of the market can again be a more robust all-weather portfolio, and that's what I'm particularly interested in. Right, let's have another little look. What am I going to talk about next? I think now I've talked about the spread. I wanted to just quickly, I also get the odd question before I talk about rebalancing about how people should use the stock ranks with things like dividend yield. Let me just refresh this page and set it up and go and actually add the yield. Because if I was to click, let me just cut out all the micro caps again. Let's cut out all stocks 100 million and less. And then I want to save this to, there's a little button here on the left that says save to my screens. If you click it, it creates a screen. This is the best stock rank above 100 million. And I can now edit these rules, and I can now add a new rule, basic rule, and I can add the yield. Let me add just the historic yield. And I can ask for example, a yield of greater than 2.5%, let's say. And when I click Get Shares, the yield column will ask me if I want to add it. Done. The yield here, and now we can see a lot of these shares are coming through. And this is how I would suggest that people who want to implement their own strategies using stock ranks would go in and customize it and use different ratios. They put it up there in the screener. If you wanted to edit your table view, you can click on this tab, click the blue button, click Profile, and I'll add sector in the industry. And let's say, what else do I want to add? I mean, maybe that'll do for now. But I wanted to add the spread, because as we said, the spread is very important. And add that in and save the changes. And there we go. And we have a nice customized view, which gives us lots of information there. And now you could use the same process for going down and finding, for example, the energy shares that, a couple of energy shares, a couple of financials, a couple of industrials, to build up a good, strong, high-yielding portfolio which has reasonable spreads with a high stock rank. And our testing on this has shown that it actually has been a very good performing strategy too. So that's another little bit about a spin on the NAPS portfolio that might be interesting. Now, I wanted to talk again about rebalancing because this is something very, very important, and I get a lot of questions about it. Keeping your balance. Now, you remember, over the course of a year, what happens? Well, if we go back and look at the NAPS portfolio, and I click the allocation tab, we looked at this earlier, and we can see this broad spread of different position sizes. International greetings at 8.5%. You've got Lamprel at 3%. It's getting a bit wishy-washy. Now, it's nothing massive to be concerned about, but if international greetings had a profit warning, we might lose 4 or 5%, or maybe more, who knows? And we want to minimize that risk of individual stock risk. And that's something that rebalancing can do. Personally, I prefer to position size equally. It keeps things simple. It avoids overconfidence. Yes, a lot of investors might like to put more larger bets in high conviction shares, and I know great investors like Leon Boris does that. I know that plenty of investors who have and done it very successfully, but you do need great stock specific skill. For people that are looking for something, a simpler approach, I believe in equal weighting positions. Now, when you rebalance, should you rebalance back to equal weighted position? Well, that depends on a couple of factors, something called threshold based rebalancing. I want to talk about that in just a minute, but I wanted to talk before that about why we rebalance. Obviously, prices drift and position sizes drift, but it's not only those. The exposure to the sort of payoffs, quality, value, momentum also drifts. So if I was to go back and look at the holdings, we can see that, yes, a lot of them are still 90 ranked, but some of them are slipping back to the 80s. Some of them are slipping into the 60s in terms of the stock rank. They're no longer qualifying for the original rules that we set out. And we might want to actually go and find stocks which are much more exposed to those factors. Now, obviously, we did that when we built this NAPS webinar portfolio, which is here. And we can see that these in general have much higher stock ranks. Rebalancing into this set, one hopes, would do better than staying with the original ones. So that's the kind of theory behind it. And but obviously, whenever you rebalance, there are costs. One has to pay commission. One has to pay the spread, which, as we said, can be high. It could be 1.5% of the portfolio, and you might have to pay tax, stamp duty of 0.5%, etc. So the cost could actually end up being 2-3% of a rebalance. So one wants to minimize this over time. I really suggest people read this article, an excellent article by Ben Hobson about rebalancing. Now, those with a good memory will be going, Ed's being a bit tricky here. He's not. He actually did some rebalancing a half year, and that's right. I did. I wrote an article which basically set up a rebalanced portfolio called the SNAPS, and we said in the article that we compare it with the NAPS as the year progressed. Now, in the SNAPS, we basically did just what we did in the current webinar, and we rebalanced in pure equal weight into what's called the SNAP into the new portfolio on the 1st of July. And this is the performance. The pink line shows the semi-year rebalanced SNAP portfolio. It's underperformed the one that we didn't touch, which I think is either means that should say to people, don't mess with something if it's not broken, don't fiddle too much, but it could be, but there are other lessons in here. In theory, rebalancing is a very wise idea, but in practice, if you rebalance into a lot of other microcap stocks, you might get unlucky. Now, clearly the snaps have not done badly. They've actually done very, very well. They've still dramatically outperformed the FTSE, and they've outperformed a lot of other approaches too. But they haven't done quite as well as our original untouched one. But it won't necessarily stop me from trying again in my own portfolio. Personally, I rebalance a quarter of my portfolio every quarter, and that's just the way I like to do it. And it's been proving quite effective for me, so I continue to do it. But when rebalancing, there are some really important things to think about. The frequency of rebalancing, the more frequently one rebalances, the more that there are frictional trading costs. If you're in small caps, that can be very expensive. Portfolio size, larger portfolios can afford to rebalance more regularly, especially if they invest in large caps, partly because the commission as a proportion of costs becomes much smaller. So larger portfolios do have an advantage. And obviously, if you're in a tax-efficient vehicle, you will avoid your CGT costs, etc., etc. And so ISAs and SIPs might be able to do more trading. And I think that's all very important to understand. Joel Greenblatt says annual rebalancing is kind of ideal. I like staggered rebalancing because it keeps me busy. I like being able to do something every quarter. If I was to buy all my shares at one point in the year, I would go mad for the rest of the year. And that's really what annual rebalancing does. People will buy at one point of the year and then they'll rebalance a year later. But then all the rest of the year, they'll just watch their portfolio. And of course, that need to do something can be quite detrimental if you can't. It's like an itch you have to scratch. So I like quarterly rebalancing a quarter of my portfolio as it works for me. And to be honest, I don't personally bring everything back to equal weighting. I like to let things grow, and then if things get too far, I will use what is called a threshold-based approach to rebalancing. So if something gets too big, I will cut it and bring it right back down to half the size. And I owned some Indivior earlier in the year, and that did very well, and I actually rebalanced it out and still held it. But when it started coming off, it actually meant that I actually saved a lot of the performance. And this is an important point. Andrew Ang is one of the top professors about factor investing and rebalancing. And he's got this lovely quote: rebalancing is the simplest and yet one of the most powerful ways of buying low and selling high. And I think that's a very, very important point. It's a way of actually profiting from volatility, and the market is too volatile. So I think that's an interesting thing. In terms of, should one buy more? A lot of people average down. Personally, I don't like to average down. I'm much more likely to sell when things go the wrong way. I use stop losses. I personally would only buy shares back and add to them if, for example, something pulled back and the stock rank remained very, very high. But that's because I use the stock ranks for my system. But I actually prefer to edge out of shares that are going the wrong way. So I kind of use personally a combination of sort of systematic clockwork rebalancing, but in order to minimize transaction costs, I don't tend to brutally bring everything back to equal weighting. I do that more on a kind of an annual basis, but I don't do it within the year. Right, here's a little slide that shows all of the portfolios that we've discussed. I'm pretty sure that we've talked about all of these. I hope I haven't missed anything. You can see here the very best portfolio is the one we didn't touch, the 2 from each sector. The second best was the half-year rebalance portfolio. The third one was the 10 stock portfolio, and the one that didn't do as well was the top 20 by StockRank undiversified. Now, I wanted to. Now I'm pretty much coming to the end of what I wanted to talk about. So I'm going to just check a couple of things. If anybody is interested in learning more about anything that we have been talking about, it's not that easy to find. But if you go over the home menu, and you can see there's some regular columns over here. If you click on portfolio tips, you can often find there's a lot of discussion, great articles by Ben. I've done some about managing a portfolio, which we're hoping to put into an ebook. Also, there is one called the StockRank Reviews. And in there, you can find a lot of information about how to use the stock ranks, a lot of articles. We've got a good archive there. We're always publishing something every month about it. So it's a really good place to go and dig around in the archives. And obviously stay tuned on the discussion boards. And one more thing I wanted to say is please do send feedback through the site. Please do send feedback if I've emailed you, please do let me know your thoughts. If anyone is actually, a lot of people were joining the webinar wanting to have a little look at the site and learn more about what we do, you can take a 5-day trial at that link there. Please do have a good look around. It's completely free for 5 days, and we won't be maintaining that link for very long. And I hope that you can actually go and start learning how to use the site, etc. And if you do and you're in there, we'll see if we can find any sort of introductory rates for you if you want to get started. But anyway, I hope this has been a really useful session, and let me know if you've got any feedback.